UK 30-year gilt yields hit 5.8% on Tuesday, the highest since 1998, yet the trigger was not a budget overshoot or a surprise inflation print. It was a political rebellion inside the governing party, and that distinction matters for every gilt holder trying to price what comes next. Nearly 80 Labour MPs called for Keir Starmer's resignation after local elections wiped out roughly 1,500 councillors. 4 ministers resigned on the same morning. The immediate market read was fiscal risk. If Starmer falls, a successor, whether Andy Burnham or Angela Rayner, would likely spend more, borrow more, and tax differently. Oxford Economics put it plainly. Long-end gilt yields would remain elevated even if short-end pressure fades, because term premia would rise on the expectation of fiscal slippage from whoever follows. But the political signal is only half the story. The 10-year yield spiked 10 basis points on Tuesday morning before pulling back as cabinet ministers publicly rallied behind Starmer. That partial reversal tells you the market is not yet pricing a full leadership change. It is pricing the uncertainty of not knowing. XTB's research director Kathleen Brooks called it a double whammy, the political crisis compressing on top of an energy price shock from the Iran war, creating the conditions for what she termed a bond market meltdown in the coming days. Rachel Reeves, the Chancellor, pulled out of a City of London event that morning without public explanation. Her absence amplified the signal rather than calming it, because the gilt market had treated her fiscal rules as the floor beneath UK sovereign credibility. The moment her attendance became uncertain, investors had to price the possibility that the floor itself was negotiable.
The political crisis on its own might have been containable. What made gilt yields difficult to cap is that the energy shock underneath it is not political, and it has no domestic resolution. U.S. inflation hit 3.8% in April, the highest reading since May 2023, driven by Iran war energy costs. That number matters to UK gilt holders because it changes the Federal Reserve's path, which in turn compresses the space the Bank of England has to act. If the Fed holds or hikes into elevated U.S. inflation, the Bank of England faces a narrower window to cut. And with UK inflation set to rise toward 4% according to EY's latest outlook, the bank is already caught between a slowing economy and a price level that won't cooperate. Bank of England MPC member Megan Green put the central bank's position in direct terms. The institution is in a terrible situation, weighing rate hikes against an energy shock that simultaneously kills growth and drives prices higher. That is the classic stagflation trap, and the instrument for escaping it, rate cuts to support growth, is the same instrument that makes inflation worse. The Iran war's transmission into the UK economy is visible across consumer-facing businesses. Greggs raised meal deal prices again. ShoeZone posted first-half losses more than double year-ago levels, blaming both Rachel Reeves's tax hikes and the war. EY projects UK consumer spending growth at 0.3% for 2026, effectively a stall. The question that first chapter's gilt crisis left open is whether a new Labour leader would stabilize those yields or accelerate their rise. But this chapter reveals the problem beneath the problem. The energy shock persists regardless of who sits in Downing Street. Two separate pressure systems are compressing UK financial conditions simultaneously, and they share one structural feature. Neither can be resolved by the other's resolution. A Starmer departure would not lower oil prices. An Iran ceasefire would not resolve fiscal uncertainty inside Labour. That independence is what makes the current configuration harder to price than either event alone. The gilt market's behavior is the verification instrument. If 30-year yields hold above 5.8% over the next 2 to 3 sessions, even after Starmer commits to a timetable or survives the immediate rebellion, the market is telling you the energy-driven inflation premium is now structural, not attached to a single political outcome. If yields retrace below 5.5% on a political resolution, the trade is simpler. The political premium was the driver, and the energy shock's gilt impact is being absorbed. The 5.5% level is the threshold that separates those two readings. The recovery case requires both components to move in the same direction: a credible political resolution that anchors fiscal rules, and oil prices pulling back below $100 as Iran peace talks advance. Markets rallied 2% on FTSE when oil briefly retreated on ceasefire optimism, which quantifies the relief valve. The downside case needs only one of the two to worsen, because the two shocks are mutually reinforcing in the inflationary direction. Higher oil feeds UK CPI, higher CPI pressures the Bank of England toward hikes, and hikes raise gilt yields further independent of fiscal risk. The leaning tilts toward continued yield elevation through this week.
Starmer's chief secretary refused Tuesday morning to confirm the prime minister would lead Labour into the next election. That is not a statement a market can price as stability. Until either a clear succession timeline emerges or oil drops sustainably below $100, the checkoff element introduced at the open, the 5.8% 30-year yield, remains the life benchmark. What would prove this wrong is a credible, coordinated signal from both Starmer's office and the ceasefire talks within 48 hours, a combination the news flow has not yet produced. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.